Good morning, everybody, and thank you for joining us at the Cassels CPD Day 2021. It's a pleasure to have you online today. We have over 200 people registered for today's sessions, and I'm certainly not expecting all of you are here for me, but I'm thrilled if you are here this morning. Good morning and welcome to Private M&A Trends. Before we get started, a couple of quick logistical points. The program runs from now, 9 a.m. until 4 p.m., with presentations starting every hour on the hour. Feel free to submit questions electronically throughout the day. They will come up to me on my end. Thank you to Nicole and Kelly and G and the team on my side for the technical support. They will ensure I get these questions. We'll get through as many as we can throughout it. Please feel free to ask. And of course, as I always say, if there's anything offline, many of my topics could take an hour on their own, even though we only have 45 minutes. So we could talk about anything offline that you'd like to. We'll get to all of that in a moment. Before we jump into the formal proceedings, so a quick land acknowledgement. We'd like to acknowledge the First Nations, Métis, and Inuit peoples of Canada, whose ancestral lands across this country many of us reside on today. So without further ado, let's talk private M&A trends. And I guess the first question I'll say is, my first question is, gee, there it is, perfect. The first question is going to be, how do these buttons work? But they do work. Some very quick things. Your CPD credits are there. I think you should know those. There is some professionalism, which we'll get to. And if you have any questions on that, please reach out to Nicole. What are our objectives today? We're going to discuss some recent trends in private M&A, deal activity, and terms. We're going to explore some changes to the due diligence processes that we're seeing engaged on deals and that we're using on deals. And we're going to present drafting suggestions for purchase agreements in addition to discussing other developments. So we're going to start with current practice trends, and I'm going to go relatively quickly through some of the business things we're seeing because it's really just there to set the context for the legal insight we're going to discuss today. But it's going to go without saying for most, if not all of you, that M&A activity in Canada on the private side is extremely robust, to make it blunt. As you'll see here, everything is up. Number of announcements, value of announcements. In some cases, not record highs, although I will say the reports we're getting suggest that across North America, 2021 is on track to be a record year for private M&A by virtue of a number of metrics. So it is an extremely busy market. We look at the private M&A market generally. There's a lot of data here. By all means, you can take time to review it later. But what this shows us are a couple of things. One, the breakdown among industry groups of the types of deals we're seeing. You'll see quite active here are information technology, real estate, metals, and mining. Those appear to be the top three. The other thing I'll point out in the second chart down below is that mid-market remains quite important for Canada in terms of M&A and candidly across North America as well, although the numbers are a bit higher in the US. As you'll see, the first bullet under the right-hand side down below, mid-market transactions below $250 million comprised 91% of the quarterly activity. So some of you may say 250 million is a pretty high number for mid-market. I will also cite the CVCA's study, which said 85% of the first half deals that they studied had a disclosed value of less than $25 million. Other trends that are related to this, of course, we're seeing more buyers in the market. In addition to strategics and traditional private equity, we're seeing family offices come into the market. Search funds, of course, have been active the last couple of years. And just generally, any number of buyers and structures are being deployed because there's a ton of dry powder out there. There is a real motivation to put money to work, and there are a number of companies coming to market. These data points are from the JP Morgan study. Now, it is US only, but it gives you a bit of a flavor of a couple of things. One, it shows per the top chart that a lot of the deals are in that 250 million and under range. And again, the US numbers are bigger. And in the lower chart, it shows you that private equity, among other financial buyers, really plays at that mid-market because most of the private equity deals under financial buyer are that 100 million and less range. Something I'm asked about a lot, EBITDA multiples. And this chart's interesting. It comes from the Duff and Phelps study from the summer. And on one hand, it aligns with what I'm seeing in the market, which are multiples are up 10 times and plus. On the other hand, I look at historical numbers here, and it looks like 10 times multiples have been common for the last 10 years. So I guess I say to you, If you look at the sectors you're interested in, I think this gives you some good data points. The average, I'm not sure, is particularly helpful, but certainly we just closed a large deal in real estate. EBITDA multiples are high there. Tech, I don't have to tell people on this call, tech multiples are extremely high as well. So generally speaking, multiples continue to be high. Certainly, there are many businesses which have done well in the past 18 months, and we'll talk later about how buyers are trying to bridge valuation gaps where they're worried about sustainability of EBITDA as things continue to hopefully get back to normal. So now into the legal side of things. And one thing we're going to spend some time with today is the practical law what's market study. And the reason we do that is despite the relatively small metrics in terms of data points, they've got 67 deals they study. It is a good reflection of some trends you're going to see in the Canadian market. I would say good, not great. A few of them I would take issue with. And one main reason is a lot of these data points come from 2020, whereas 2021 has been a very different year. 2020, of course, we had at a macro level, as everybody knows, a lot of uncertainty for many months. We then had in the second half of the year a number of deals that were kind of on hold in the Q2 come back on, but we didn't see a ton of new M&A activity. Well, that changed significantly in 2021. It has been an extremely busy year, as I've mentioned. It is very much a seller's market. We are seeing trends creep north from the US that are more sell-side friendly, which we'll get to as well. So I give all of that to give you a bit of context on the strengths and weaknesses of the What's Market study. Very briefly, as you'll see here, this shows you the kind of industries that are part of the study. Mining and metals continues to be a very, very well represented one in Canada, but you'll see all the other industries that are represented as well. One thing I will note from another study I looked at, and we'll talk about today, which is from SRS Acquium, significant increase in the percentage of deals with buyer equity as a component of deal consideration. So in other words, you're getting some rollover shares in the buyer entity as part of the deal, up from 13% in 2018 and 15% in 2019 to 21% of 2020 deals had buyer equity. My experience is that will be even higher in 2021. So there's the first kind of structural trend we are seeing. Now we look at the type of deals that are part of the practical law study. Clearly, the biggest buyer in the study is corporate at 96%, and the biggest seller is by a bit corporate. Now they go with the principal nature of the buyer or seller here. So if the buyer is a portfolio company of private equity, they're going to call it corporate. So this data point is not particularly helpful, but that being said, it's there. So now we're going to look at how you address the purchase price in transactions and what the trends are like in terms of those purchase price metrics, for lack of a better term. We've got escrow here. I'm just going to move this. Here we go. We've got escrow here. And as you'll see from the chart, the escrow numbers in 2020 are kind of, they're up from in escrows up from 2019, but down from 2018. Here's what I'll say to you on escrow. Certainly, I saw more escrows used in late 2020, early 2021, as people were getting their heads around whether it was indemnification concerns or purchase price adjustments, so they would hold back some of the funds. So I would argue that in my experience, escrows were up significantly, and I think the SRS Acquium study shows the same. Holdbacks obviously is a negotiation point. In many cases now, you've got so many professional escrow agents out there like JP Morgan that it is going to be tough for buyers to continue to say we should hold it back as opposed to an escrow agent. But of course, for the buyer, holding back is better than escrow. Escrows and holdbacks, release period and purpose. So you'll see a couple of cool data points here. The first is that the release period was up significantly in 2020. Look at more than 24 months of a release period for your escrow or holdback. 25% of deals. So that aligns with what I said previously. More concern. We want to see everything kind of run its course in terms of these companies they were buying, and therefore have the escrow or holdback run for a longer period. You will also see again, per my last comment, indemnification claims and purchase price adjustments were both up. Purchase price adjustments significantly in terms of the purpose of that escrow or holdback, which again makes sense as buyers try to get their heads around the numbers. Gee, if we can go to the next one, please. I'm still having, thank you. Median percentage of purchase price was 9%, so up slightly. Again, really provides for what I've described, which is more concern on the buy side. And note that 5/20/20 transactions had escrow in excess of 20% of the purchase price. That's a big number. Next slide, please, G. Escrow trends. So this comes from the JP Morgan study. I'm not going to spend a lot of time on it, but it does show you that the average duration of 15 months, relatively long there, so it's greater than the 12 months, but most escrow durations are 12 to 18 months. This is interesting. 17% of deals had at least one indemnity claim in terms of the JP Morgan experience as escrow agent. And this is really important for everybody. What are the common types of claims? Tax, litigation, financial statements. So this is real data in terms of the types of claims that are emerging from these transactions. Strategic buyer deals had on average a longer duration than financial buyer deals. That makes sense, right? Private equity is typically going to be a better risk matrix kind of assessments in place. They're going to understand the risk piece of some of these transactions and the indemnity claims, the indemnity paradigm, and so on. Whereas strategics are saying, we're buying your business, right? We expect it to do A, B, and C, and we're going to make sure it does. And we'll hold on until we confirm that. G, next slide, please. Adjustment metrics. Now, we're talking about purchase price adjustments, right? We talked about escrow and holdbacks. Now we're in a separate category, which is how are you adjusting the purchase price? And what are the metrics you're using in terms of what you're paying, not how you pay it, which is escrow and holdback. You'll see here that working capital and debt were by far the two biggest in 2020. Not really a surprise there. Working capital is typically, as you'll see, the primary way that purchase prices adjust. And again, adjusted. And again, it comes back to that kind of concern on the side of buyers, especially last year, around the sustainability of EBITDA. What is the business going to do? What are we getting when we take this over in terms of debt? Did you ramp up the debt in 2020 to an unsustainable level? So all of this, I think, is borne out by the realities of 2020. And G, next slide, please. Now we get to something I think that is really germane to not only 2020, but 2021 earnouts. Now, of course, as you'll know, earnouts are really there to say to the seller, listen, if you think your company is worth X and we think it's worth Y, and X is higher than Y, then let's go with an earnout. Because if it is really worth X based on an EBITDA metric or another metric that we can kind of diarize, then you'll make a lot of money. And if we're right and it's worth Y, then we won't have overpaid for this business. So it really is a way to bridge valuation gaps. And that's precisely what we've seen over the last 18 to 20 months. From the SRS Acquium study, before we jump into this, they saw significant developments that they believe were influenced by the pandemic. Number of deals with an earnout, percentage of deals with an earnout increased significantly. The median earnout potential as a percentage of the closing payments increased significantly. And again, this was to bridge valuation gaps. Now, again, the data doesn't really bear it out here. 2019 to 2020, you actually see earnouts down a little bit. But in my experience, earnouts are up significantly. And we'll talk about what that means to you as drafting lawyers. G, next slide, please. What are the metrics they use? You'll see, again, as I said previously, revenue, EBITDA are the biggest ones. Royalties are big, obviously, in the extraction industries like mining and metals and oil and gas. But other observed metrics include milestones, asset value, and share price. Again, business point predominantly. We're going to get to, G, the next slide, please. We're going to get to some of the drafting suggestions we're going to have for you. A couple of comments. One, the term of the earnout. You'll see getting longer, right? In 2020, greater than 36 months was 50% of earnouts. And that tells us a few things. A longer earnout can mean a number of things. It allows the seller more time to get the earnout targets, but at the same time, they have to wait longer to get fully paid on the earnout if they hit those targets. A longer earnout gives the buyer more time to make the earnout payments, and it reduces the risk of a short-term focus on achieving the earnout in lieu of longer-term gains. So that's an interesting kind of development we saw in 2020's data. In terms of the covenants, which are, of course, also relevant to you as a drafting party, you'll see that 50% of the deals incorporated explicit covenants regarding conduct of the business during the earnout period. Now, these covenants are significant, right? These are covenants that say things like, buyer has the right to operate the business in any way that it deems appropriate in its sole discretion, versus buyer will not take any actions primarily designed to prevent any payment of the earnout? Or do you have events of default that would result in an immediate payment of the earnout? So, for example, if the buyer merges or sells the company they just bought, or if the buyer sells substantially all the assets that they just bought, does that immediately trigger payment of the earnout? This is where, as corporate lawyers, we really have to put our heads together with the client, with the accounting firm and or investment bank, and say, what are the kind of parameters of this earnout? And whether you're on for the buyer or the seller, these are things that have, of course, post-closing implications, and you want to be very careful about drafting them. If you're on for the buyer, one thing I think you want to avoid at all costs is any suggestion, expressly or implicitly, of a good faith obligation to run this business. As all of us know from the Basson case, from any number of cases that follow it in Canada, once you introduce good faith into the equation, you're putting that buyer under a lot of pressure to operate the business in a form that really preserves the kind of sanctity of that earnout. Whereas if you're on for the seller, absolutely have a good faith covenant to operate the business post-closing. G, next slide, please. I don't see any questions so far, but again, please ask them as they come. We're now into due diligence developments, and our timing is great. This is perfect. Next slide, please, G. So why do we care today about due diligence? Some of you may be doing diligence, others may be leading teams on diligence. I really want to just remind all of you about our Law Society Act Rules of Professional Conduct, in particular Section 3.1, which is competence. And this section, as you'll see on the right, says a number of things. But the two I really want to stress this morning are, number one, you need to know the general legal principles and procedures and the substantive law and procedure for the areas of law in which you practice. And that's A as an alpha. And H as in Henry down below says you need to recognize limitations in one's ability to handle a matter or some aspect of it and take steps accordingly to ensure that the client is appropriately served. So for us as corporate lawyers, this is really important, right? Because on any given day, we are dealing with a number of issues. We are dealing with, in my practice, for example, mergers and acquisitions in a number of different industries. And within those different industries, of course, different verticals of practice expertise and so on. An example, just this morning, I was on the phone with my international trade partner, Brenda Swick, because one of our clients is doing contracts with a country that I won't name, but we were worried about the potential of sanctions, the potential for sanctions in relation to that company and that country. So having that international trade lawyer able to kind of parse the law, look at the Canadian sanctions, the United Nations sanctions, the US sanctions, was relevant because this same company is in a process to be sold. So the diligence that the buyers will do on that company, especially if it's a US buyer, to confirm whether this company is doing business with countries that are on sanctions lists, and likewise in Canada, under the Foreign Extraterritorial Measures Act, things that could give rise to concerns on the Canadian side. This is something that I don't do every day, the international trade component. So it's a great reminder of how important it is to, A, refresh ourselves on the relevant areas of law and M&A, and I'm going to give you a few of those here today. B, to pull in people where you are over your skis, so to speak, and it's not your practice area. Sorry, the doorbell just rang. Your practice area on a day-to-day basis. And C, ensuring that you are doing the study, the CPD processes and the like to maintain the standard of a reasonably competent and diligent solicitor, because that is the test that the case law tells us is relevant. You don't have to know everything, but you've got to do your best to stay up to speed on things and to seek help, which may not be legal help, right? If there's an environmental assessment of phase one, you're not doing that. Your environmental colleagues are not doing that. An engineer or a consultant is doing that. G, next slide, please. So what are some due diligence trends we are seeing? The first one, I suspect will be known to all of you, is resource constraints. The remarkable nature of the past 12 months in M&A in Canada and the US, which is relevant, of course, has meant that any number of service providers, I would argue most service providers in the M&A world, are extremely busy. And I'm seeing a bottleneck that I haven't seen in my 20 plus years of practice. So where's it coming from? Of course, on the legal side, we are losing talented associates, all of us are, to the US. We're losing them to private equity funds. We're losing them to any number of strategic acquirers around the world. And these are great opportunities for these young lawyers. I'm certainly not undermining that piece, but it does mean on the resource side, we've had to be very adept. We're using more digital tools than ever before. We're bringing in team members from other offices to make sure we service our clients appropriately. So it's working, but not without some stress. Similarly, as we'll talk about later in the piece, rep and warranty insurance. There is no question that the representation and warranty insurance industry is both A, really busy, and B, looking at this demand and saying, okay, we can kind of be a little more selective, if you will, about the deals we underwrite, about the terms we take on, the deals we take on, the fees we charge. There is no question a bit of a resource constraint in the rep and warranty industry. And the third one I'll just cite would be the accounting industry. And for those of you at accounting firms or who work with accounting firms, generally speaking, they are extremely busy. And specific examples, it is very difficult in my experience and from what I hear from clients to get Q of E reports done quickly and turned around quickly because of that resource constraint. So what does that tell us? It tells us, per the previous slide, we have to be ready for that, right? We have to have a few perhaps rep and warranty insurance brokers on call, a few accounting firms ready to go, because the one you've used traditionally may not be ready to service that deal you're trying to get closed by year end. G, next slide, please. This one is a pretty straightforward one, but again, speaks to the importance of staying up to speed on things. For those of you who joined me last year, you'll recognize most of this chart. These are COVID-19 related questions that I submit you should have as part of your due diligence request list on any deal where you're the buyer. They speak to things like employment law. Do you have any employees on temporary leave or who have been terminated due to COVID-19 or policies around COVID-19? If so, please provide a list of such employees, identify the date they were terminated, and so on. Really, this chart speaks to a number of different areas, including employment, real estate, and the like, where these really are relatively new developments, right? And things that we now have to think about in terms of practical things. Do you have enough employees to service your clients? To liability aspects, to regulatory aspects, and the like. So I suggest you take a look at these, you incorporate them into your checklist. Something else you should consider when you're doing diligence on the buy side is reviewing the target's obligations in case of things like force majeure, et cetera, in respect of pandemics like COVID-19 or any other public emergency or disaster that results in a disruption of the supply chain. How does that play out in your client's contract, your target's contracts? So purchase commitments, as I said, force majeure, are there termination penalties? It's again, a relevant thing as you're doing your diligence to consider. And final point on this slide is using technology, which we're seeing more than ever before, and certainly our 4 Lines group at Cassels is using more than ever before, to provide support on diligence, to make things as automated as possible, to streamline workflows. All of this is as important and more important than it ever has been in this world of really remote due diligence for the most part. G, next slide, please. So now we're still in diligence, we're still in this world, and let's talk about compliance. And by compliance, I'm talking about anti-corruption and anti-bribery policies, kind of the trade sanctions I mentioned earlier, and no coincidence, Brenda Swick is the one who helped me with these slides, so thank you, Brenda. As you're doing your diligence, keep in mind that globally governments are increasing the use of anti-corruption legislation and empowering enforcement agencies. We have the Corruption of Foreign Public Officials Act in Canada and similar legislation. Be aware of the extraterritorial reach of that legislation. Just like my example earlier about that country my client's doing business with, you need to be aware of not just the Canadian impact of doing that business, but what it means in other countries, whether that ricochets back to you under FEMA or similar legislation. And as I said earlier as well, bring in, where you need it, foreign counsel, other professionals, where it's just not within your purview. Next slide, please, G. Okay, article in the Globe and Mail, you will have seen that Canadian companies are now self-reporting allegations of bribery, and the reason they're doing that is to take advantage of the 2018 Criminal Code Amendment that could allow them to pay financial penalties rather than face trial and potential conviction under the CFPOA. According to Brenda, that, among other things, is a trend we need to take note of, because what it relates to, of course, are the deferred prosecution agreements or mediation agreements and the like that allow companies to work with the prosecutor to stay proceedings while they comply with the terms of that agreement. And that's relevant, of course, for anybody doing diligence on an M&A transaction or anybody acting with a company that could have such breaches in their corporate structure. Other input from Brenda, your due diligence must be fluid and risk-based. And what she means by that is it's got to cover third parties and agents. That's where a lot of these bribery and corruption things play out, right? It's not the direct company. It may not be their customer. It's the third parties and agents in between. So you got to increase your scope of diligence in that respect. You've got to look at all the relevant sanctions, be aware of U.S. extraterritorial measures, which I mentioned. And in Brenda's words, not asking the right questions or turning a blind eye is no protection. So you've got to make sure people knew their obligations. You've got to find out if they didn't follow them. Okay, what does that mean and what are the implications of it? Another point from Brenda, Canadian authorities are increasingly following U.S. precedent on sentencing, terms of probation orders, and required compliance measures. And those are, to my knowledge, higher than ours. And finally, companies should be regularly reviewing the implementation and execution of their financial crime compliance measures. These are all things that are relevant to your diligence. And if you're not using them as part of any deal you have, which has an international component, you should be doing so. G, next slide, please. Input from some other colleagues of mine, David Ackman, who just joined us as head of our competition law group, and Tegan O'Brien, who is a great young lawyer in that group. There are 3 comments for you to keep in mind in terms of trends. Number 1, the Bureau has signaled a more aggressive approach to reviewing mergers. I'm going to spend a bit of time on this one because I think it's the most important. Recent enforcement action by the Bureau and public statements by the Commissioner of Competition indicate that merger reviews in Canada are likely to take longer, be more costly, and be more likely to result in litigation. So again, this could be a whole hour session, but just want to put that on your radar that we've got to be cautious in terms of any transaction where there's a competition law component to that development. The Bureau is now clearly on a litigation footing as well, they add, and there was an injunction applied for in the summer, unsuccessfully by the Bureau, to hold up a transaction that they felt should not proceed. Next bullet is foreign investment is subject to enhanced scrutiny post-COVID. Since April 21, certain foreign investments have been subject to enhanced scrutiny under the Investment Canada Act, including national security reviews. So they're looking for anything related to public health or the supply of critical goods and services. So please keep that in mind as well. And finally, the Bureau's top sectoral enforcement priorities include digital services, pharma, health, and financial services. The words that were cited to me are any merger that could impact ordinary Canadians as consumers is going to attract increased attention from the Bureau, or is likely to do so. G, the next slide, please. And then the next one. Material adverse effect. Why do we care about this? Well, we care about it because of the material adverse effect that impacted all of us in 2020 and also caused corporate lawyers the world over to look more closely than ever before at not only the definition of material adverse effect in our contracts, but how it plays out throughout the contracts. And of course, we followed all of that very closely before, but 2020 really forced us to say, okay, where do you cover off COVID-19? Certainly, it is a multifaceted, complex discussion. I'm going to do my best to simplify it for you and really just give you some things to think about. But let's start with this definition. Without asking anyone to read it, there will be no quiz later. Number 1, you'll see this definition has, and this is why I've separated as such, 3 components. The first component is, what is an MAE? It is an event, occurrence, fact, etc., that's materially adverse to A, the business, basically, of the corporation, or B, the ability of the corporation to consummate the transactions contemplated. So that's what an MAE is. Where does it play out? It plays out in your covenants. It plays out in your representations and warranties, and it plays out in your conditions, right? As the buyer, you want to know that there's no MAE in any of these areas. Then we go to the second part of this definition. These are the exclusions from an MAE, right? This is where it says MAEs shall not include an event that's attributable to, let's say, a general economic or political condition. If something kind of globally or on a nationwide basis happens, that shouldn't be triggering the MAE definition. And so, of course, these are the exclusions to an MAE definition. But then you say, okay, but what if that exclusion hits the target company? Let's say we're buying Acme Corporation. Let's say these exclusions, like general economic conditions, like the pandemic, hit Acme Corporation disproportionately vis-a-vis other clients in that industry. Isn't that an MAE? And that's what you'll see the third paragraph does, which is where if there's a disproportionate effect on the target, then indeed something in those exclusions is an MAE. And G, if we can go to the next slide, why do we care about this? A couple of reasons. One, you'll see that in terms of representations and warranties, just to take one of the uses of MAEs, They are used as a qualifier in 87% of share purchase agreements and 63% of asset purchase agreements under the practical law study. So they're out there, which means what? Which means in the reps and warranties, you're giving the seller a bit of a break and saying, I'm going to qualify this rep and warranty by an MAE. But it certainly means as a buyer, you care about that definition of MAE, and it cannot be rendered useless by the exclusions. So G, the next slide, please. Check out this slide from SRS Acquium study, which is a North American-wide study. The yellow piece shows you the reference to a pandemic, et cetera, in MAE clauses. The orange one shows you reference to COVID-19 expressly, and you'll see how that came up certainly in Q3 and Q4 of 2020. And then the green one is a reference to COVID-19 related government actions in the MAE clause. And then the black one, the last one, is the exception for disproportionate effects. So while included infrequently prior to 2020, a pandemic was added as an exception to the definition of MAE in more than 3/4 of deals by the third quarter of 2020, frequently accompanied by an exception for disproportionate impact of the pandemic on the seller company. So don't have a ton of time on this, but I'll say this. If you're the buyer, you want to be very clear that if the COVID-19 pandemic and other things related to it are excluded from the definition of MAE, that you have a very detailed inclusion piece below it that says, but hold on a minute. If it hits your EBITDA by more than X%, or if it causes a disruption to your operations of more than Y days, there are any number of ways we've worked around this to ensure that buyers are protected. As the seller, you want to come to the table and say, listen, I've had to do certain things over the past 18 months that should not be reflected as an MAE. Everyone in my industry has had to do them, or even where I've had to do a little bit more. It is what it is, because what I'm delivering to you today is a company that's in better shape as a result of that. So some things to consider there, and we'll move to the next slide, G. Rep and warranty insurance. Next slide again, please. It goes without saying that rep and warranty insurance is more important than ever before in Canadian transactions. That trend has really come north from the US, and we're seeing it not just in private equity deals, but in most deals these days. We'll at least consider rep and warranty insurance. I'll get to consider because it's not as easy to get as it was before. According to the ABA, late last year, over 75% of deals done by PE firms used rep and warranty insurance in the US, and 50% of deals done by strategics. We're not at those numbers yet, but I certainly think we're trending upwards towards them. And this just tells you some of the data points. I mean, again, this practical law doesn't really support my thesis here. Number of deals in which insurance was purchased was actually down in 2020. I would argue that this is an issue with the data set versus anything. G, next slide, please. So now we look at these trends. These, I think, are really important because this literally comes to us from Robin Weber at Hub in terms of what she's seen on the street. This, I think, tells us how robust the demand is for rep and warranty insurance. Number one, due diligence fees are up by a small amount, but a large percentage, right? 40,000 to 45,000. Number two, minimum premiums are up by by 100,000 plus in just the last few months. Number three, minimum retentions, which again are like your deductible, are up from 150 to 200K to 250 to 300K. And number four, rate trends are up. So this is for a 10% limit, i.e. 10% of the purchase price is the coverage you're getting with these rates. Look at Canadian deals. Last year, 3 to 3.5% of total enterprise value. This year, 4 to 4.5%. That is a percentage point higher in terms of what you're paying for rep and warranty insurance. Now, in terms of a deal that's $100 million, that's a lot of money. A couple of other comments. It is so busy that one-off deals and or deals in the sub $50 million range have become extremely difficult to get placed, and there are fewer carriers quoting on those deals. And the other thing I'll note is, as I said earlier, because the markets are short on underwriting capacity, it's more selective in terms of deals that rep and warranty insurers will do. G, next slide, please. So what does this mean to us in terms of, obviously, rep and warranty insurance is important, right? It's going to play into the entire liability paradigm. What does it mean to us? If we can go, G, to the next slide, that'd be great. So these are some strategies that I've deployed over the past 18 months. Some are for the buyer, some are for the seller. They're really just to get you thinking about, number one, the increased pervasiveness of rep and warranty insurance, and number two, how it plays into the things that we've all been negotiating for our entire careers: liability caps, recovery, survival, and so on. So here's an example. Are we seeing in Canada a strong trend like the US towards sellers having no exposure for anything other than the rep and warranty insurance, other than for fraud? The answer is we're starting to see it. It's nowhere near as pervasive as in the US, but we're starting to see that kind of trend and really bringing down the exposure of seller, maybe not to no recourse, but to a lower number. One thing I'm seeing quite a bit is sellers being exposed to a percentage of the retention subject to fraud, fundamentals, and the like. And that, of course, will be negotiated on every deal. But let's take a deal that assumes there's some exposure for retention, and then there's rep and warranty insurance. So sellers could say, hey, buyer, you need to go to the rep and warranty insurance policy for everything except fraud, fundamentals, and perhaps tax. However, if you're on for the seller, you may also say, even for those, you need to go to the rep and warranty insurance if there's room. Then you get into the second and third bullets, well, I guess the third and fourth, which are, you've got a recapture concept, which says, if you went, play for fundamentals, you went to the rep and warranty insurance policy, you got recovery under that as buyer, but then there was a regular breach, right? Under a regular rep and warranty, not a fundamental one. And under that regular breach, your claim under the policy was rejected because coverage was exhausted. This language protects the buyer because this says the sellers are now liable for those rejected damages up to the amount of that claim, up to the amount of that bona fide claim under the regular rep and warranty that you had. So that kind of respects the ability of the seller. If this is what it takes to get a deal done as the buyer, which is increasingly what we're seeing, this is a way to respect the ability of the buyer to kind of send you the policy for a number of different purposes, while at the same time preserving the sanctity as the buyer of saying, yeah, but if it's a fundamental, that policy is not my cap on coverage, nor is it your cap on liability. Another thing to think about are crossover claims. What if there's a claim? Because our job, of course, is to look at the practical implications of what we draft, right? It's very easy to say you got to go to the policy, but in an agreement, as you know, there are reps, there are covenants, there are standalone indemnities. What if, in the fog of war, so to speak, under a dispute, a buyer could go under a breach of rep, clearly covered under the rep and warranty insurance policy, or a covenant, which may or may not be covered, or an indemnity, which may or may not be covered. The discussion becomes whether the buyer must go to the rep and warranty insurance policy in the event of that kind of dichotomy. If you go under either, you got to go under the policy. But then you could come back to the recapture concept I described earlier. And if you're on for the buyer, you want to ensure that you toll the survival periods for the time during which buyers pursuing that rep and warranty insurance coverage. Now, of course, I'm giving you these so that you know, A, what we're seeing in the market, and B, regardless of who you act for, you have some creative solutions at your disposal. If you're on for the buyer, I think the argument is you push back on a lot of the foregoing, or at a minimum, allow the buyer to pursue coverage concurrently under the rep and warranty insurance and the other covenants. What does all of this mean? It means because of the intense market we're in, we're going to see detailed and intense negotiations around different liability caps for diligence findings and concerns of the buyer. If the buyer finds something around regulatory or litigation or IP or environmental, and that's a standalone indemnity, how does that fit into the liability paradigm, rep and warranty insurance, crossover claims, and the like? And B, it means you're going to be addressing items excluded by the rep and warranty insurance policy more than ever before. Are there COVID-19 exclusions? What are the other exclusions that come often, as many of you know, just before you sign and close this deal? How do you address them in terms of the indemnity? And finally, what is the interplay of all of this with rep and warranty insurance? So we're going to move to our last topic with 5 minutes to go. Thank you, Nicole. Good timing. Next slide, please, G. Indemnification. This slide we're going to be very quick on because it's just to remind all of you how a standard survival clause looks. You'll recall that when you've got reps and warranties in an agreement, and of course indemnities for a breach of such reps and warranties, they'll survive the closing for a number of months from the closing date. Again, we're talking private M&A today, although I've heard there are some examples in the US of no survival. That to me is more of a public M&A concept than private. So we'll go to the next slide, please, G. And what are we seeing? We're seeing in Canada, again, to 2020, we've got the default survival period is kind of the 12 to 24 month period. I would argue, and I mean, here it says common default period overall was 24 months. I would argue that is no longer correct. We are certainly seeing the US model come into play. SRS Acquium reports the median survival period for indemnity escrows remained 15 months. but there were more deals with short, i.e. less than 12-month survival periods or no survival. So I would argue that 12 to 15/18 months is becoming more of the median in Canada. Of course, broad comment, many, many things to consider as you negotiate it, but just keep that in mind as you're discussing survival periods. Next one, please, G. What are you carving out from that standard survival period? Of course, fundamental reps and warranties, often an indefinite survival period. If the sellers don't own the shares, that should not be limited by any form of less than reasonable survival period. Taxes, of course, should correlate to the applicable review period, the assessment period. Environmental matters, I'm seeing anywhere from 2 to 5 years survival. Covenants and fraud, typically indefinite survival. Next slide, please, G. Defining losses. As many of you know, one of my favorite things to do is talk about losses, right? It's easy to write in an agreement where you're liable for X, you're not liable for Y. It's really important, though, to take the time on any transaction and think about what that means. So you'll see in the practical law study, it's taking you across the bottom. Apologies for the difficulty you may have in reading this. The types of damages across the bottom are incidental, consequential, special, aggravated, punitive, and exemplary. And yes, it sounds like your law school contracts law case, because that a lot of times we don't see these definitions used day to day. All I would say to you here is the following. Number one, be aware of the case law, right? Be aware of cases like Atos and Sapien, which remind us that under Hadley and Baxendale, things like loss of profits can indeed be direct damages, right? If you're in a contract with someone and their breach causes you to lose profits directly, those are direct damages, versus the indirect concept of loss of profits, which is their breach may cause you to lose profits from other contracts. So number one, be aware of the law in these areas. Number two, do what I do, which is especially on larger deals where you're really in a battle on these, whether you're on for the buyer or the seller, sit with a litigator, right? Take 15, 30 minutes with a litigator, go through these headings of damages, and more importantly, play out the reality, right? Like, what is it you are worried about? If you're on for the buyer, you obviously want as many heads of damages included as possible. At the same time, recognizing that in a sell side market like we're in today, you can't be overly aggressive in many cases with this, because the seller will say, I just want to walk away from this business, right? I've got rep and warranty insurance, or I'm willing to give you a reasonable indemnity, but no more than that. I need to kind of put my head down at night X years from now and not worry about these things. So do go through these, think about what they mean to your deal, and think about whether or not your damages definition has a real feeling of reality, right? If it correlates to the deal you're doing, the types of losses that are likely to come up, how it plays in with your entire agreement, including your indemnification clauses. I will add to it, another trend we're seeing for sellers is if there are disputes in a number of areas, like contractual ones with big suppliers and customers, the sellers want to control that defense to make sure that they keep that kind of goodwill going and hopefully minimize damages on it. Plays into mitigation and other issues and the like. But the point is very simply this: be aware of these types of definitions and how they play out on your deal. Final slide, because we're really done now. This will be important for you, G, as we go to the final slide. What are the caps on liability? 2020 here, to make it fun, is now a different color. It's the black color. You'll see it's 25% or less of deals. It has come down, 25 to 50%, around the same. 50% to 100%, it's gone up. Candidly, I don't think this data is particularly helpful. In my experience, liability caps on the sell side are coming down, even regardless of rep and warranty insurance. So let's say there's no rep and warranty insurance, exposure for sellers has come down as a percentage of purchase price. Again, because buyers want to get the deal done. They want to be really thoughtful about what the sellers are exposed for, and at the same time recognize the sellers do want a finite survival period and cap. That's what I've got. If there are any questions, let me know now or later, and thank you for your time.